Welcome to Online Trading Campus. This is Jan Skoropinski with you today, starting our new 2020 Unique Forex course. Welcome to Module 1, Fundamental Awareness. Lesson 1, the Monetary System. This is the agenda for today. At first, we will quickly go through the evolution of money, followed by looking at what money is today, and lastly, we will talk about the history of money. Henry Ford, founder of the Ford Motor Company, once said, "It is well enough that people of the nation do not understand our banking and monetary system, for if they did, I believe there would be a revolution before tomorrow morning." This sentence is very much applicable today. Even 100 years later, we can arguably say that most people do not really understand the monetary system. Why? Mark Twain, an American writer, once said, "It ain't what you don't know that gets you into trouble. It is what you know for sure that just ain't so." The same is applicable to the monetary system today. There are many myths and misconceptions, and that's normal because money is something special. It is universal and creates things that go beyond just money. Money exists since more than 1,000 years. Throughout history, money has taken a lot of different forms. First, the barter system, then cash in form of coins and paper money, later as banknotes, followed by even virtual money, and today we have cryptocurrencies. Today, money has gained the greatest importance in its entire history. First, global money supply has never been greater. Second, global debt, money that only exists in form of claims, is continuing to rise and is also at an all-time high. Thirdly, the expansion of the wealth gap, meaning the unequal distribution of money. Never in history has a small group of people owned so much. And lastly, one of the most important extremes of today, interest rates, which have always been attached to money. The function of interest rates is quite simple. Whoever lends money demands that more money is going to be repaid at a later stage. This concept is completely changing. In the first time since history, we're seeing a phenomenon, a monetary experiment really, called the negative interest rate. The European Central Bank, the ECB, the Bank of Japan, the Swiss National Bank, and the Bank of Sweden all launched negative interest rates. And with high probability, we can expect negative rates to be launched in many more countries, like the US for example. With negative interest rates, the current monetary system is completely turned upside down. Let us quickly do a thought experiment on negative interest rates to really understand what they mean. Whoever lends money is going to get less money back in return. But who's willing to take this bet? One that you know you're going to lose from the beginning. You probably have guessed the answer, the central banks. For the person who borrows money, negative interest rates have a different effect. This means that the borrower has to give back less than they originally borrowed. Technically, this means you could simply borrow money and be paid for doing nothing. But not so quickly. Before you guys now decide that you want to fly to Japan or Switzerland to profit from the negative interest rates, it is not as easy as that. If we go to a bank in Switzerland, then we definitely will not receive the kind offer of negative interest rates. Even if you're going to ask very, very nicely. Negative interest rates you will only come across once you open a bank account in those countries. However, in this case, negative interest rates mean that part of your money will be taken away every year. This means that the normal hardworking employee is only experiencing the negative effects of negative interest rates. So now you may ask, but who is profiting from negative interest rates then? Well, it's easy. Large businesses and financial professionals who understand to use this system in their favor to further expand the wealth gap. This is the so-called Cantillon effect. In case of a monetary expansion, the ones who profit from it are the ones who are close to the money. Close to the money in this case means everyone who can access the money right at the beginning. For example, big companies, banks, and so on and so forth. They get loans and make investments. Prices then start to rise even though the rest of the population has not received any of the new money yet. This part of the population usually is not the one with too much money. Nonetheless, they have to pay the higher prices even though they have not profited from the increase in money at all. The result is a redistribution from the poor to the rich. Alright, let us look at the past to better understand how the monetary system that we see today came to be. Let us start roughly 6,000 years ago. Back then, people were nomads, meaning people traveled and lived from hunting and collecting. After some time, they began forming settlements. This was the start of a new era in the way how people lived. In addition to hunting and collecting, people now also started agriculture, first wheat and later also stock breeding. With the enhancement of agricultural methods over time, villages and settlements were able to produce more than they needed. And with that, settlements began trading the things they did not need. People realized that through the trading system, the so-called barter system, the standard of living massively increased. And as a result, the first marketplaces and trading places were formed. Presumably, not much later, people established a common base of value. Yes, of course, you're thinking about gold, silver, and bronze, but not so fast. At first, people looked at goods which were easy to transport, easy to store, and ones that did not perish easily. So first they used salt, tobacco, dried fish, or even animal fur or fabrics. Their value was equivalent to the amount of labor that was required to produce them. So depending on different cultures, people started to accept these different types of goods as a general means of exchange. For example, pearls, rare animal teeth, rare stones, and only sometime later, precious metals. Very soon, these precious metals took a special place. While their values were first measured in weight, people realized quickly that they were able to change the forms of these kinds of metals. The forming of these materials led to coinage and thereby the first launch of what we would call cash today. Let us talk about some potential misconceptions we may have during this time, which proves Mark Twain's quote I used to start this lesson. First misconception: banks were only created after the creation of money. And secondly, interest rates are an invention of bankers. Both are false. The banking system was founded during the barter system, prior to coins. For example, rent or lease was paid in natural goods. You could even create deposits, of course, everything in form of tradable goods. Also, the principle of interest rates could be observed way before the use of coins. Interest rates originate from the Sumerians, the inhabitants of Mesopotamia, which is today's Iraq. The word the Sumerians used for the interest rate was the same word they used for cattle cups or goat cups. So someone who lent a cattle or a goat would expect an interest rate in the form of an additional cattle or goat cup. So at some point, people started to form these metals into sticks, bars, or rings. The oldest known to man coins were produced in Asia 650 before Christ. And roughly 600 to 700 years later, also the Roman Empire started to circulate coins with a portrait of the emperor. This was again another epochal step to the money we have today. You had money which was circulated by the rulers, who now had the monopoly over the creation of money, and as a result became more and more powerful. Again, an interesting fact: if you think that only the Romans started to tax their people, then you're again wrong. Also, taxes existed prior to the establishment of coins. For example, going back to ancient Egypt, also in the form of natural goods. These are important findings when it comes to the history of money, because they show that they were no revolutionary innovations, but rather they were taken from existing behavioral patterns that could be observed back in the barter system. Let us go back to the coin money era. Coins were only means of exchange for the next 2000 years. They were mainly three precious metals that were used to make coins: gold, silver, and copper. Towards the end of the Middle Ages, the first banks were established in Europe. Banks that did not work with the barter system but with coin money. They originated in Florence, Italy, and soon were seen across the entire continent. As a result, you had a couple of banker families who spotted these trends early that became super rich. After some time, banks became as powerful as the rulers themselves. With the creation of nations at some point, national currencies were soon established. And with that, banks for the first time formed central banks. Now, let us talk about another misconception here. Central banks were not created by national policymakers or rulers or kings to, for example, regulate the banking system and the monetary system. No. Banks themselves created a central bank for one reason only: to become even more powerful. For example, the Bank of England was founded in the year of 1694 by bankers that provided money for the king's warfare affairs. This is important because rulers or kings from France, England, or Sweden became dependent on the lending from these central banks, which they needed for warfare. Since then, the real power of each nation lies with the banks, because they can determine who gets money and who doesn't get it. In the mid-18th to early 19th century, the age of industrialization, central banks established paper money for the first time. Of course, as you can imagine, in the beginning, there were quite a lot of monetary accidents, because back then, nobody had heard or thought about the phenomenon of inflation. As you can imagine, a lot of central banks just started the printing machines in the spirit of Buzz Lightyear to infinity and beyond. And as a result, money was devalued rapidly. Sounds familiar to today, right? But the banks learned quickly and decided to regulate the money printing press. How did they do it? They simply decided that paper money had to be backed up by precious metals. Now the banks realized quickly that in a lot of cases though, their hands were now tied, because they could only lend out as much money as they had available in gold or other precious metal reserves. As a result, banks started arguing the fact that they didn't need all the gold as reserves all the time, because the risk of all customers running to the bank and wanting to exchange their paper money for gold all at the same time was very, very unlikely. And with this argument, the reserve principle was born. So banks only had to reserve a certain amount of percentage of gold for the lending of money. This is a historic milestone in the banking industry, because for the first time in history, banks were allowed to create money which didn't exist before. Now we are starting to go further down the timeline, and the topics are becoming more and more relevant to today. While we covered Europe, let us now take a look at the US monetary system during the same period, which is specifically key to understand the monetary system we have today. The current monetary system we live in originated during a conference in a little town called Bretton Woods in the year of 1944. What happened during this conference is historic, because the US basically dictated, due to their military superpower, that all other nations' currencies are to be fixed against the US dollar. This was the so-called Bretton Woods Agreement, which suggested to peg the US dollar against gold and other main currencies were then fixed against the US dollar. In the US, banks were divided into a few extremely powerful banks, which were known under the umbrella of money trust. In here, you had banks like JP Morgan Chase, for example. Contrary to Europe, where central banks had already been formed and had all the rights for money creation, banks in the US had not yet formed a central bank. Until 1913, it was the US government who had the rights to create money. Now, a handful of large banks that combined represented a quarter of the global wealth teamed up with a few American policymakers and created an American central bank using the Bank of England as a model. The name of the concept, the Federal Reserve, which was advertised as a regulatory authority, which was supposed to control the money trust banks. In 1913, this concept was brought to life. The central bank in the US, the Fed, or the Federal Reserve, was born. This is another milestone of the monetary system because this meant that the biggest banks in the world, not just in the US, worked together, forming a cartel. And as a result, they are much more powerful than even the White House. And with the Bretton Woods Agreement in the year of 1944, the US dollar became the world's first reserve currency, and with that, the US Fed became the most powerful central bank on the planet. At some point, however, the US budget and US trade deficits exploded, and more dollars were created and circulated in the global economy, which created an increasing gap between the circulating US dollars and the gold reserves that these dollars should be pegged against. In the 1960s, more and more investors understood that this happened and started to exchange their dollars for gold. Of course, the government back then had to step in and pull the emergency brake. In 1971, the US dollar pegged to gold was cancelled, which you may know President Nixon is famous for. Now, this was one of the biggest milestones of the monetary system we see today. This was the birth of the so-called fiat money. Money which was not pegged against precious metals, but rather lives from the trust in the system. As a result, the monetary system was more and more deregulated, which brought about the biggest boom in the financial sector that we have ever seen, which more and more divorced itself also from the underlying economy. This is the process that shaped today's monetary system more than anything else in the past, to an extent that the entire financial system, in other words, Wall Street, almost collapsed in the year of 2000, the dot-com bubble, and the year of 2009, the housing crisis. And today, it has become obvious that the monetary system can only survive through massive manipulation from the sides of the central banks. The 2000 dot-com bubble could have led to a total collapse of the global monetary system, but the Fed stepped in and invested $4 billion into the financial system. Seems like pocket money if you compare this to the Fed's $3 trillion of liquidity they pumped into the financial markets during the Corona crisis, right? But just 9 years later, in 2009, there was another collapse of the financial markets, the housing crisis. This is a major turning point in the history of the monetary system because since the housing crisis, the central banks of the world provided billions of dollars that they provided the financial markets, and for the first time in history also at a 0% interest rate. 0% interest rate for the first time in the US. The argument was simple though. This is only temporary, so they said. Since 2018, however, we understand that this is not true. From 2015 to 2018, the central banks around the world, especially the Fed in the US, tried to go back to normal interest rates, decreasing their balance sheets. Fair enough. This trial, however, of the Fed failed miserably in the year of December 2018. As a result of increasing interest rates, the stock markets collapsed and suffered losses that were last seen during the housing and dot-com bubble. As a result, the Fed flip-flopped this trial and started lowering interest rates again and again. And in 2019, the Fed decreased interest rates 2 times in a row. Now fast forward to September 2019, the so-called repo markets became into trouble, which is the overnight funding marketplace for banks. And as a result, the Fed injected $500 billion into the repo system from September 2019 to January 2020. During the same period, also Christine Lagarde, the current chairman of the ECB, the European Central Bank, promised to further lower interest rates in Europe and provide more monetary stimulus for the financial system. This is a major milestone yet again because it shows that the monetary system can only survive with massive intervention and billions, no, trillions of dollars of liquidity. Then in April 2020, the Fed bailed out Wall Street with $3 trillion of liquidity after the corona crash. And since this is a one-way street now, central banks also have to be willing to experiment to provide further stimulus in the form of negative interest rates, which we talked about earlier. Another new and creative way for central banks to further create stimulus is the concept of helicopter money. Helicopter money, in simple terms, is freshly printed money that's paid directly to individuals who then can go and spend it in the economy. All of these measures have one thing in common. It shows that the monetary system can only survive with massive intervention and billions, no, trillions of dollars of stimulus. This first lesson is so crucial because it talks about many topics we're also going to cover in this very comprehensive Forex course. We will not just focus on Forex itself, but due to Forex being the heart of our monetary system, we will also have to cover topics like interest rates, negative interest rates, central banks and what they do. We will talk about the economy and Forex and the rise of so-called zombie companies and how they affect the economy. We will also cover precious metals extensively, which by definition can be seen as a way of exchange. Forex or FX is short for foreign exchange, and gold and silver have historically played an important role in this. Also, cryptocurrencies should not be neglected as they have been shown to move similar to gold and silver. We will also talk about CFDs, contract for difference, which are derivative products we can trade through our Forex brokers. They come in many forms, but more about this in the CFD lesson. Let us first start with Forex basics, which we will cover in the next lesson. So until now, thanks everyone, happy and safe trading, and I will catch you all for the next lesson. Ciao.